Okay, let's dive into this recent warning from JPMorgan. It's a call that has the market talking, but you know what? The real story isn't just the headline. We're going to deconstruct what's really happening behind the scenes, what the market seems to be missing, and what it all means.
So, we're going to break this down into 6 key parts to really get the full picture. We'll start with the warning itself, then dig into the market's true vulnerability. After that, we'll look at a secret signal that saw this coming, the bigger economic threat lurking, the crucial escape hatch, and finally, what you should be watching right now.
All right, first up, let's look at the forecast that got everyone's attention and the simple story that's being told to explain it all.
The story kicks off with a trigger we've all seen before. Oil prices have surged past that critical $100 a barrel mark. And the reasons? Well, they seem pretty straightforward. Production cuts from the Gulf states and, of course, ongoing geopolitical tensions that just don't seem to be cooling down.
And that spike in oil is what prompted JPMorgan's head of global market intelligence to make a very specific tactical call, a 10% drop for the S&P 500 from its peak. But here's the thing. That number, it's not actually the most important part of this story, not by a long shot. So what if the oil price isn't the real problem here? Let's get into our second point, because the true danger, the real weakness, lies in how the market was, or more accurately, how it wasn't prepared for this news.
This quote from the note absolutely nails it. You see, the market's reaction isn't just about the bad news itself. It's about how ready the market was for that news. A shock hitting an unprepared market, that's what creates those super fast, super violent sell-offs. And this brings us right to the heart of the matter, market positioning. JPMorgan's team described investor positioning as neutral. In fact, get this, traders were actually net sellers of energy stocks last week, betting that things would de-escalate. They were leaning the completely wrong way, totally caught off guard. This right here illustrates the difference perfectly. Just think back to the COVID crash in early 2020. The incredible speed and severity of that drop was because the market had just not priced in that kind of risk at all. That's the exact dynamic being flagged right now. A huge gap between how risk is priced and where it probably should be.
So you might be wondering, if the usual alarms, like market volatility, were pretty quiet, how could anyone have possibly spotted this danger building up under the surface? Well, it turns out there's a pretty specialized tool that's been flashing red for almost a month now. It was picking up on signals that a lot of the more common indicators completely missed. And that tool is called the Turbulence Index. Now, it doesn't just measure fear. It measures something much more specific, something systemic. It's looking for a breakdown in the normal relationships between different assets. You know, like when stocks and bonds, which are supposed to move in opposite directions, suddenly both start falling together. That's a huge red flag that your diversification strategy might suddenly stop working. Now, what's really fascinating is how different this is from the VIX, the famous fear gauge. Think of it this way. The VIX tells you if the market is shaking. The Turbulence Index tells you if the market is breaking, if the fundamental relationships holding portfolios together are starting to crack. And that, my friends, is a much deeper problem. So why does a crack in the market's foundation matter so much right now? Well, it points to a much bigger economic threat that could be looming on the horizon. The deeper risk that this whole situation is waving a flag about is a temporary but potentially very painful bout of stagflation. And that's that toxic, nasty combination of rising prices happening at the same time as slow or stagnant economic growth. And you can see the chain reaction pretty clearly. High oil prices, they act like a supply shock. So they push inflation up, while also acting like a tax on all of us, consumers, businesses, which slows down the economy. And boom, the result is that classic stagflation dilemma. And here's why that really matters. It traps central banks, like the Federal Reserve, in an impossible position. I mean, what do? Do you raise rates to fight inflation and risk crushing an economy that's already slowing down? Or do you cut rates to try to help growth and risk letting inflation run wild? This policy paralysis, that's a huge risk that the market has just not been pricing in. Okay, now, before anyone rushes to hit the sell button, it is so important to understand the nuance here. This is a warning, not a prophecy of doom. They are being crystal clear about this. This is a short-term, tactical warning. It is not a call for some kind of long-term bear market. It is entirely conditional on the current geopolitical situation. The note says flat out that a real off-ramp to the conflict would end this bearish call. mainly because the underlying economy is still seen as pretty supportive.
So, let's bring this all home. What does this all mean for you, and what are the key signals you should actually be monitoring as this whole story unfolds?
Well, the analysis basically gives us a clear checklist. Number 1, obviously, keep an eye on oil prices. 2, listen very, very closely to what the Fed says on March 18th. 3, watch that positioning data to see if the big institutions start to de-risk. And finally, watch corporate earnings for real-world impacts and keep an ear out for any news on that separate tariff dispute.
Ultimately, the real takeaway here isn't about trying to perfectly time the market. It's about asking a different, and I think much better question. Is my portfolio prepared for an environment where the chance of a pretty significant fast drop has suddenly gone way up? And that brings us right back to the beginning. The writing was on the wall. These warning signs of a structural breakdown have been there, quietly flashing from that turbulence index for almost a month. The quiet signal was there long before the loud one.
Which leaves us with the final, provocative question. The signals are flashing. The disconnect between where investors are positioned and where the risks really are has been flagged. The only question now is the market finally paying attention?